Perfect. Well, good morning, good afternoon, good evening, everyone. Thanks so much for being here and carving out some time. My name is Chris Castro. I serve as the Chief Sustainability Officer here at Climate First Bank, and I'm really excited to moderate another Green Note webinar discussion on a critically important topic. Over the last, few months, we've discussed topics that support nonprofits with fundraising and being more financially sound. We've learned about the concept of green banks and how they're catalyzing clean energy nationwide. And this month's topic sits right at the intersection of climate action and real-world market decision making, really buildings and how we can clean them and green them up. So for over a decade, I've actually been dealing with this topic. I've been working on this topic of building decarbonization and the idea of ultimately the challenge of how do we replace carbon-based energy sources in our homes and our workplaces with cleaner technologies, technologies that will reduce energy and carbon, will make our properties safer and healthier and certainly more resilient to the changing climate. And too often we talk about this term decarbonization in a very broad terms, but when it comes down to it, the reality is that most of the progress happens building by building, deal by deal, owner by owner, right? These projects are often bespoke and requires a tailored approach to making these upgrades happen, which also makes scaling up the solution very challenging. And for many middle market building owners, those buildings between kind of 2 million in value and 100 million in value, they make up the majority of our communities. There's still this big gap between knowing the improvement and what needs to be done and actually having the tools and the partners and the financing to act on it. Right. And that's this missing middle that we're here to talk about today. How are we closing this gap? And especially for those owner operators that may not have the balance sheets or access to capital like some of the large REITs that are out there. And so joining me today is a panel of experts in the space. We have Rob Bernard from CBRE, who's going to be representing the building owners and managers perspective and giving us a little bit of insight about what really drives them. We have Brad Doxer with GreenGen, a premier energy service company operating in the US and abroad. A lot of experience over the last couple of decades doing this exactly. And Bob Zakowski with Sustainable Credit Partners, or SCP. It's a newly special financing provider and a partner of Climate First Bank with a real focus on this whole area of building decarbonization and sustainable buildings. And so we're really excited about it. To get us started, fellas, I thought it would be lovely for each one of you to go around, briefly introduce yourselves a little bit more. You could talk about your background and your organization that you represent, and then answer one lighter question to warm us up, and that is, what's your team? What team is your choice to take the World Cup 2026 this year? And Rob, I'm actually going to turn it over to you to get us started.
All right. So I'll start with the last part. I mean, kind of feel like, of course, it's got to be the US. Um, and hopefully I can stay awake late enough tonight and watch the game here on the East Coast. So excited to see what's going on uh, in the next round. I mean, today, hopefully we'll do well and we'll get the next round. My background, I've been doing sustainability since about 2007. I actually started this journey. I was the first, it was called environmental strategist, but I was the first head of sustainability over at Microsoft. I did that for about 10 years. And then headed over into the private equity world where I worked on circular economy and waste streams. And then came back to sort of the more corporate life as head of sustainability for CBRE. Actually, they've never had a chief sustainability officer before I joined. And
Hmm,
then we've expanded the role and the remit to actually encompass not only sustainability, but also energy and how all of those things come together. So I'm super
nice.
excited to sort of be here today and see if we can unpack some of the stuff that we're hearing and seeing literally every day in the market. So thank you for inviting us.
Appreciate it. Thank you, Rob. That's fantastic. Brad, let's go to you.
Yeah, thanks. So just by way of background, so my background's a little bit different than most everybody else in this space. I came at this really as an investor. I started at JMB Realty. I spent a decade at Starwood Capital, where I founded Starwood's international business in Asia and Europe. And we founded GreenGen 15 years ago, really out of a frustration that we were not able to find somebody who not only did the strategy or insight piece, but actually the execution, because it's
Mm,
the execution of the insight that creates the value. And so we work globally around the world. Typical year, we have revenues in more than 20 countries. About half our business is private sector, so large global investors. The other half is public. That's primarily in the U.S., federal, Army Corps of Engineers, cities, states, where we're executing and driving value from that. And I also think it's interesting. I also sit as a trustee of ULI. I sit on ULI's Global
Hmm.
Sustainability Board, and I am now what's called a counselor of councils. I sit above the product councils, advising all the chair of four different product councils on how to maximize the benefit for members. World Cup, super interesting for me because I was the chair of the host committee in 1994, and so this tournament holds a lot of things near and dear for me. And while my heart says the U.S., I'll go with Rob. My brain says France.
France. Okay. They're looking sharp. Both teams are looking sharp, I will say, thus far. So we're still a little early, but all right. We got a US, we got a France. Bob, close us out here on the intros.
Yeah, thank you, Chris, and it's an honor to be with everybody on the call. I did have to send a text message to my attorney claiming either surname or age bias here, and the fact that I've going last. So we'll see what happens there. My background: I am in my fifth decade of my career, and I think of my career in two blocks. The first was global finance and real estate and private equity, where I had a chance to start my career on Wall Street, work at big firms like GE Capital, Colony Capital, Oak Tree Capital. And then
Hmm.
roughly 12 years ago, I retired from that first career and I started a second career in impact investing, where I can use the knowledge, network, and capital that I developed for during my first career. What strings my careers together is everything that I've been involved with has had some element of innovation, either new market entry, new market development, new product development. I'm currently the founder and CEO of Conduit Capital, which is the sponsor of Sustainable Credit Partners. At CCAP, what we do is we innovate, incubate, seed, staff, and launch new impact ideas. Our focus is to try to create or facilitate impact at scale by activating capital at scale, but not in the traditional way, in the manner of raising, a multi-billion monolithic fund. What we try to do is find major needs that are not being currently met by other investment managers and developing a product to be able to address that with our theory of change being if we do that well and we get the intended outcomes, both financial and impact, that others will follow suit and invest in that space under our
Hmm.
theory of replication. In terms of World Cup, naturally, I have to say that my heart is with the home team. But after watching Brazil yesterday, I would have to say that they're looking pretty sharp as well.
I was going to say Brazil sharp, Argentina is pretty sharp,
Yeah.
but I think all of us are rooting for the home team here in the U.S. and I'm happy to see that things are progressing the right way as it relates to the World Cup there. Wonderful, really great mix of perspectives here today with market players, with implementation experts, with people. All three of you have real experience in finance in one way or another. And that's exactly what makes this conversation so important because, in my experience, building decarbonization only moves when those pieces actually connect and they come together, right? And they can actually move in a streamlined way. And so, to kick off this conversation here, I think it's important for us to set the kind of market context. And before we start talking solutions, we need to understand what's challenging for building owners and managers right now today. Across the market, owners and operators are being pulled in multiple directions at once. They're facing rising operational costs and growing tenant expectations about what buildings should offer. And then there's this increasing pressure around building performance from not just state and local governments, but I'd also argue investors that are starting to really care about this topic. And so, Rob, I'd love to turn it over to you to, bring us first to start about sharing more of these insights on the CRE marketplace today from your perspective, and what are the key drivers for you and your colleagues on a day in and day out basis?
It's a great question. And so I'm going to try and break this down into a couple of components because it's as many things. It's not one universal thing,
Mm,
right? And so if we take sort of where are we in this moment in time, right? We've got advances in technology and data, which is making it easier, not yet easy, but easier to do things like capital planning, forecast, ROI models,
mm,
interventions of whether it's a net zero pathway or whatever the motivations are. So I think we're still a few years away, but I think the speed towards almost commoditizing insights is getting better and better and better. And hopefully we're part of the cohort of companies, along with Brad and his great company, of pushing that sort of insight, right? So you go, okay, but even when I have the insight, why doesn't the action happen?
mm,
Right? So now you run into a couple of things. One, you run into sort of the landlord-tenant problems of lease and lease terms, and we can call them green leasing, but like what are the lease
yeah.
parameters that actually create innovative opportunities for more cost sharing? That's one. And then one I know we're going to talk a lot about is, okay, I see the road that you're laying out for me, but where's the capital? Right? And how do I get
Hmm.
access to that capital and how do I think about that? Right? And then, well, what's the impact for me, but if I'm an investor for my LPs, and how do I think about that? And even in a world where there's like a, our numbers say, depending on where you're in the world, 5, 7.5, maybe north of that lift in valuation when you make some of these interventions. Well, what's your time horizon? What's the nature of the fund? How much sort of freedom do you have as a GP? All these kinds of things start to come into question. And so it's like there are multi factors here. One is insight. Again, I think we're doing better as an industry. I'd say as a company, certainly on driving that insight.
Hmm.
Then there's sort of like, well, where does capital come from and how do I think about that? Then there's investor pressure. Then there's sort of lease disharmony. And then the
Mm,
last piece, which we're starting to see more and more now, and we can talk about the root causes of this is, oh, volatility in energy prices actually makes this a little bit more confusing. Like, how do I actually really think about my saving? How do I think about what futures in energy? And so part of the thing that we've done also is we've expanded sustainability, which has historically been more focused on efficiency and carbon, to also think about energy and energy contracting, because this has now become a much more acute variable in the conversation for our clients than even 12
mm,
months ago. And I'd say AI now plus the Gulf War has really taken this thing, which was like a back burner for the last, I don't know, decade or
wow.
decades, and literally
Hmm.
put it in the room in the conversation. And so it's all of these things. And I know we're going to hear from people who are super expert on this, but then it's like, what's the unlock at scale? Like we can sit down with a client and walk through a bunch of stuff and almost hold their hand through a transformation. But the thing is, how do we create the conditions where instead of a pull, from us to clients. It's a push from
Hmm.
clients to the people on this call to say, hey, I want to go faster. Help me go faster. Not, hey, we're trying to convince you why you should go faster.
Yep.
So
It
that's
just
sort of
seems
what we're sort of saying. Yeah.
it just seems that often building owners are reluctant, right? They're not sold on this idea, and for practitioners, it seems like it's a no-brainer opportunity, right? You're improving your asset value, like you mentioned. You're saving on the operational cost. You're retaining tenants. As studies have shown that, they have higher rental rates and they're retaining tenants better. But it doesn't seem to like stick when you're in the boardroom, so to speak, and they're looking at all of the different factors. And so, like, what's the business case that you're seeing from a CBRE perspective that's really moving the needle in these boardrooms that's helping to drive the investment in the right way?
Well, there are a couple of triggers. And the answer is I wish I had a very easy, glib answer and be like, hey, we figured out the magic code to unlock. But I think it depends. Right. So in some
Sure.
cases, it's motivation because of either a pending or future sale or a relay. Right?
Hmm.
And so it's like, oh, if you want to actually compete in the market, and by the way, especially outside of the US, regulatory pressures help, right? And so, oh, you want to hit certain regulatory barriers, you have to do this. So is
Hmm.
there a tenant market demand or is there a regulatory demand? That's a key unlock. The second is, can you actually convince not the sustainability teams and these investors, but the asset managers?
Hmm.
Why is it in their self-interest? And that's something that I think we're starting to see more and more success with is making that translation to like, oh, here's your return on capital, here's how your investors, and here, frankly, how you are going to make more money as the asset manager by taking these interventions. And then the third piece is help us get capital, right? Like that is an issue. We absolutely see it all the time. I'm excited to hear, Bob's take on it, your take, Brad's take. But that is, I'd say, especially when it comes to individual projects, and if you get below a multi-million dollar thing where you might have more financial opportunities, it's like, how do you
Mm.
do these 100, 200,000, $500,000 interventions in a way that actually gets the capital flowing? So there's no really great unlock just yet. But my hope is things like, frankly, valuations and also operating costs, things like insurance, all of these things hopefully will converge to help create more of a flywheel moving forward.
Yep. I think that underscore on the asset manager versus your traditional sustainability folk is a really important point to take home here because they're obviously looking at the overall valuation of these properties and what are the levers that are going to help them increase value and lower overall net operating expenses and therefore, drive more cash flows for the property. So that's really important. I mean, you have S&P Global out here saying that there's over $3 trillion in the U.S. commercial real estate loans alone that are looking to mature between now and the end of 2030. So the next 3 to 4 years, trillions of commercial real estate loans are going to need to be refinanced. And to your point, that's often the intervention that could catch them in thinking more intentionally about these types of improvements. So that's really, really helpful. I want to turn the conversation now. I think that was a really good foundation because once the owners understand the pressures and the opportunities, the next question really becomes, all right, what can we actually do about it? What's meaningful to improve the performance of my buildings and reduce my carbon footprint? And I think one of the biggest challenges in this space still is that there's a lot of confusion around this retrofit journey. A lot of owners just know that the improvements might matter, but they're unsure about where to start, how to prioritize these options, and how to go from this kind of analysis to execution. And I think, Brad, in your introduction, you mentioned that as well. And so I'd love to bring you, Brad, into this piece of the conversation and help us demystify this process. Would love to hear more about Green Gen for one, and also like take us through the typical customer journey of how you walk them through the opportunities that you identify and the strongest mix of these energy cost and operational impacts that they can have.
Yeah, so I mean, so I'll walk you a little bit through sort of how we approach it. And first and foremost, we ask the client, the customer, what success looks like. Like, what are they hoping to get out of it? We know that, higher asset values is one. We know that better access to equity capital markets, lower cost of debt, those are all things that will happen, but there inevitably needs to be a starting point. And we
Hmm.
want the starting point to be the thing that is most important to the client. I would say the majority of the groups that we work with absolutely are focused on asset value because it drives their fees and promote and carried interest. But we sometimes get involved in a situation where there's a major tenant who's got a renewal coming up in 18 months. And frankly, the focus is making sure that we address the issues that they've raised or improve the building so that they'll renew because they have then a refinancing or there's a refinancing.
Hmm.
Um,
Hmm.
going on. But we start with really once we've established that, we want to understand who the stakeholders are. I mean, I think Rob touched on it. There used to be two stakeholders. It used to be, Chris, you'd own a building and I'm your tenant. That's it. Now it's the tenant, it's their employees, it's their customers, it's their supply chain, it's their
Hmm.
investors, equity and debt. It's planning officials, unelected officials, it's elected officials, it's the community, it's your investors. So now there's like a dozen stakeholders. And while they can't all necessarily approve the project, many of them have the ability to stop a project from happening.
Hmm.
And so we want to make sure that we understand sort of who they are, what they want, what they're hoping for. And then really just it's understanding the building. It's starting with how much energy it's consuming, electric, water, gas, and steam, what the insurance claim looks like, repairs and maintenance. Um, they've all, these are all things that are really important. Data is the first piece, and then we're going on site.
Hmm.
And we ask an interesting question of the team that's on site. we asked them if capital was available, if there was, no limit on capital, what would they do? Because they
Hmm.
live in a world where they've been told for a long time, don't ask for capital, don't spend any money, just keep it running and just
Yep.
repair it with duct tape and chewing gum. And oftentimes we're seeing all kinds of different things. We look at work orders. We want to understand what the tenants' complaints are in a hotel. We're going online to see what types of issues are being raised by guests at hotels. And then we're basically establishing all the different types of ECMs that could occur. We really don't care about the return initially because the price of, as Rob said, the price of energy will change. It could change dramatically. The cost of the measure can change as well as costs come down or technology becomes more powerful. And the third category, which is the myriad of utilities and green banks and other types of public sector like organizations, are buying down the costs either by a grant that reduces the cost of the measure itself, or a green bank that has a concessionary low cost type of program to finance it so that the cost of financing. So those things will change.
Hmm. Hmm.
And inevitably they do change. And so that's really how we're sort of, adding to it. We're thinking about the financing. We're looking at, as an example, is there a reserve inside the mortgage that can be utilized? And we really want to think about sort of, again, going back to what success looks like. How do we design a project and execute a project that satisfies what the client considers to be success?
Yep, that's super helpful. I remember when I first, started getting in this game, was hired by my local county government. They had received EECBG block grant, an energy efficiency and conservation block grant, big DOE grant back in the Recovery Act. And they had me go around to a bunch of our county buildings to do Energy Star benchmarks. So ultimately, this very foundational level one essentially assessment, where we were just trying to give the building almost an MPG, right? This 1 to 100 score. How are you comparing to other partners? Um, and then it came to this. Once we identified the lowest performing buildings in the portfolio, it was like, all right, how do we actually deploy this EECBG money? And we went into the second layer of audit, and that was really that ASHRAE level two, which I think GreenGen really specializes in looking at the base building systems, the envelope, the lighting systems, right? Obviously, the appliances and plug load, service hot water, all of the components that are really energy users.
No.
I think we've lost Chris for a second.
Yeah,
Um,
who wants Star Hoods?
so I'll ad lib. It's interesting because people come at this, Rob, from very different perspectives. Some people want to renew tenants, some people want to create value, some people are trying to satisfy, key stakeholders. Um, Bob, I'll kick it over to you because we haven't heard from you yet. Um, how is SCP sort of addressing this missing middle, this sort of piece where there's aspirations on the one hand, that lead to insights. Rob and I talk a lot, so we're using some of the same words. Basically insights. What to do, but frankly, we're all dealing with investors who insight is important, but it's the implementation of the insight that creates the value.
Hmm.
How is the work that you're doing sort of transferring or translating from insight to implementation to success?
That's a good question. Hey, Chris, we can carry this without you if you want to sign off.
That sounds good. I saw that.
Brad's at the joystick.
Perfect. Thank you,
So,
Brad.
so yeah, it's a great question, Brad. I think that you and Rob are very much at the pointy end of the spear of the technical aspects of looking at a building, determining a bespoke solution that makes commercial sense for the owner of the building. While at SCP, our primary goal is to provide that financing in an easier, faster, cheaper manner than any all other alternatives, and we'll get into that a little bit more. I think the important part of what we also bring is the narrative, the demystifying what's going on, not making it a political discussion, really bringing this down to the common denominator for all the key constituencies, whether
Hmm.
it's value from a standpoint of the owner, whether it's energy efficiency from a standpoint of the tenant, or what we like to phrase as the brown discount when it comes to the lender. If you look at where ultimately all this credit in the CRE market lands, it ultimately ends up in public and private pension funds, securities, insurance company, general accounts, et cetera. Uh, Most of which are at the lower end of risk tolerance and spend hundreds of millions of dollars of evaluating embedded risk in their portfolio.
Mm.
This concept of brown discount is a new concept, which is your real estate collateral may be declining in value due to a new factor that you're not considering. And so we try to, one, make it a common dialogue. We want to make it an easy dialogue, and we want to make it a comprehensive dialogue in terms of getting everybody at the table on the same idea.
Hey, and
Excellent. I
Chris,
mean,
yeah, sorry, I'm going to jump into and
please,
then
Rob.
let's turn it back to you because you said something really interesting before. How many trillion dollars worth of loans are coming between now and 2030?
Three.
It was three, right? Oh, he may have cut. So, I mean, part of the question is we're looking for upside, but I think the fear of refinancing and not being able to clear your hurdle for your existing financing could become a real issue in the marketplace. I'm curious to hear others, Chris and Bob and Brad, like, do you think that that reality might unfold where there's enough of a discount where people are like, oh, if I don't want to dig into my pocket or raise more capital from more investors and give away more equity, I'm going to actually have to figure out how to actually replace my financing.
Personally, I think the answer is unequivocally yes. And I know in the conversation, Chris wants to talk about the kind of loans that SCP is making, and how do we compare and contrast to other known programs like CPACE. It's interesting to answer your question, Rob. I think CPACE plays a little bit of that role of a plug equity as a manner of bringing in capital that will recognize value in a manner to make a cap stack work where you may have negative equity in a refinancing.
Hmm. Well, I mean, that's an important segue actually into further unpacking CPACE, right? Because I think a lot of people, when they hear about this topic of retrofitting buildings, they immediately go to, all right, commercial pace, that's the tool, right? And in many markets where it's enabled, it can work, but there are pros and cons of it. And one of the things that, at Climate First Bank, we are a lender that is willing to finance a property where they have CPACE in the stack, right? Because we actually see the value of what those improvements are going to do to ensure a better performance of that property and therefore, lower risk in that property not meeting its debt service, right, to the bank. And so we see that value, but there are a lot of banks that are reluctant to do that because they see it. Obviously, this is a senior lien, right? When you do PACE, it acts as a senior lien on the property, so it's above the first mortgage. That becomes a really big issue, and from our perspective, what we haven't done is financed the actual PACE stack because our issue, again, is the collateral. And often you're tying just the improvement to that collateral. And so it's been difficult for us to kind of get in the game of CPACE at scale. But SCP and this idea around a bridge loan that actually supports the refinance and ties some of these, decarbonization, energy, water, carbon savings to the loan is fundamentally different. And Bob, I think it would be helpful to kind of explain a little bit more about that for the audience here to help us understand, like, how is SEP different than CPACE and what makes it unique?
Yeah, so let me start by saying, addressing the first question, which is, or the embedded question of what you said, Chris, is why is financing these building improvements, difficult? Even before I get into CPACE. And I think
Hmm.
you touched upon the answer, which is it starts with the fact that it's a mismatch in approach. A traditional lender will underwrite the building as it is today, not as it could be after the work is done.
Mm.
So the value of the improvement creates the lower operating costs, higher rents, longer asset life, and sits in the future. Most lenders won't give the borrower credit for that. And that's fundamentally what makes SCP different, which is we will look at the value of the improvements that Brad and his team will enact. We'll underwrite how that will roll through the cash flow, because,
Hmm.
like most lenders, we are a discounted cash flow analysis driven organization. But we ultimately, the math ends up with us making a fuller loan, if you will.
Mm.
So the borrower's not having to come out of pocket. The second thing is that in comparison to CPACE, and I want to be fair to CPACE, I think CPACE clearly plays an important role, not only in one method of providing financing to retrofit a building, but also, as I said, filling the capital stack for some of the refinancing goes. But as
Hmm.
as you said, it's a complicated transaction which doesn't speak to everybody, either in its complexity, or its execution, or ultimately the all-in cost. Because the fact that CPACE is a separate financing, where SCP is just one first mortgage that is essentially upsized to accommodate the retrofitting.
Hmm.
CPACE, you have to hire a number of different advisors, different tax people, different lawyers. You have to often negotiate an intercreditor agreement between the holder of the first mortgage and the CPACE. And there is the perception that that tax lien that is in place may affect the marketability of the project upon sale.
Hmm.
Yet, to date, CPACE has done $10 billion of financing. So I think it is playing an important role. But to not only reference the $3 trillion of refinancing you mentioned, SCP focuses on what we call the mid market. That we won't go as low as 2 million, as you said. Those are really small properties, but 15 to $100 million value properties. That market in the United States is $21 trillion
Wow.
in its size. And when you take into account the average age of that stock, and you then overlay the recent spike in energy costs, volatility of energy costs, property insurance costs, and everything else, the need and the opportunity for retrofit is amazingly large. And that's why
Hmm.
Rob at CBRE and other frontline, multifaceted real estate groups are so focused on this, and why you're seeing more and more lenders start to take this into account from a valuation, just as they did thinking about reserves for replacements for roofs and boilers, et cetera. We're now also including, the cost of energy efficiency.
Yep. And I think there's something to say about, we're in a changing climate and, things are getting more intense. And so this aspect of resilience and how to potentially incorporate resilience of the property and its physical risk reduction into these types of improvements is another area of major opportunity that we've been starting to look at. Another question that I have is really around how do we ensure that the measurable savings of energy, water, these different, costs, including carbon, actually strengthen the case for the financing when you guys are looking at a particular deal? Um, and yeah, would just love to kind of hear how back to the business case, why is it strengthening the overall deal by us doing these types of improvements?
Well,
Good,
I'll,
Brad.
I'll just
Good.
I'll just start. A big part, Chris, of what the work we do is changing the conversation from how much does it cost to how much value does it create, and that's really where you're going. It used to be we talked about energy efficiency. In the last 3 or 4 years, resilience has come up as a major topic, and now I think people understand that resilience has an ROI. They're a little fuzzy necessarily on the math and what it means, but occupiers care a lot. I mean, occupiers want to know that the building has backup, there's continuity of operations. They'll be able to run their business. They don't want to be down because the power's out. They don't want to be down because there's a flood or because they can't access the building because
Mm,
the transportation networks don't allow them to do that. These are all things that stakeholders are, in fact, asking every day. When you're seeing people go in and look at for office space, they're giving these requirements to their leasing broker, and leasing brokers are basically slashing half the potential buildings right off the bat because of these types of things.
mm,
This is a whole new world. I think the other part of it
oh,
is that a lot of people don't fully understand the perils, and that's the term that insurance companies use, the perils that buildings face. We had a client that asked us to look at Tampa and Savannah as new markets for them, but they're worried about physical climate risk. And I said, absolutely, we can do that. But I want you to go to your investment committee and I want you to ask them what the 5 best buildings are in their portfolio, because they'll probably say something in lower Manhattan, maybe something in Boston. And from a physical climate risk, those markets, those
vulnerable.
buildings are probably no different in terms of the physical climate risk that they face than other places that they perhaps perceive as being riskier.
Mm.
So I think that's part
That's
of
an
it.
interesting point. Yeah,
You
there's
know,
this kind of perception gap in where to focus the attention. And I'll be frank, we're a Florida-based bank here. We have a pretty big balance sheet in Florida, but not exclusively. Now across the country lending, but we've been really impressed at how we're thinking about physical climate risk in the underwriting of these properties and just making sure that it's part of the thought process and trying to figure out ways to, enhance as they're coming to financing for us, enhance ways, pre-approving as an example, solar and storage for some of these properties, and really making it easy for that owner to move forward with that improvement because often having access to the money as we're talking about here is usually a big issue, right?
yeah,
I think
and
I'll just jump in, maybe
Please.
because we're on both sides of this, right? We're both on the investor side, but we're also on the client side, like the occupier side. And so there, and Brad's seen this, because we've been doing quite a bit of work together. It's like we actually have a set of tools now that my team uses that sits across dozens and dozens of the world's largest companies, where we're actively talking with them about when you come up for release, or right, have you thought through the climate risk? And I'll just anecdotally share a story where I was sitting with one of the certainly a Fortune 50 company recently, and they were looking for new lab kind of spaces and industrial spaces. And we started basically looking at climate risk models, and they quickly eliminated dozens of sites because of either subsidence risk. And in one of their locations, they're like, well, we're a little bit worried about hurricanes. Well, we were able to go in, and with the use of AI, we're actually to look at all the permits that are filed, and the landlord had actually filed for, but not yet built, a hurricane proofing system, in effect, like a hardening
Wow.
system. Made the client much more interested in renegotiating with that landlord. So I think we're hopefully actually pushing the market a bit with our clients by saying, look, because back to my earlier statement, data is more accessible than ever, and we can be more insightful quickly. We're now able to sit with those clients who are leasing the space and say, hey, bring these things to the conversation. Think about things like, is there the land going to sink because of subsidence? You're looking at a new facility for a warehouse. How do you think about the risk in those markets? especially in the world where people need water? Are you thinking about water stress ratings?
There
So
you
I
are.
think
Yep.
I'm hopeful that we're going to see a little bit more push from the tenant side than we've historically seen, at least in the tenants that we're representing.
If I can just add to that, Chris,
Please.
as a rising lender, SCP, the CEO of our business, once said something to me that just absolutely resonated, which is we're not only in the origination business, we're in the education business. And
Mm.
so when SCP is going to make a loan on a building, in addition to deploying the normal underwriting team to do the underwriting that every real estate borrower is familiar with, and that's important to us, by the way, is we want to deliver our product in a familiar way, make it easier and for them to understand. But what will typically happen in parallel is Brad and his team will look at the property and develop this bespoke blueprint on what is a commercially viable set of steps to make the building more energy and water efficient and more resilient. And in making the loan, we will often look at Brad and his team's work and say, okay, these are the things that we would like to see done today to the property as part of the loan proceeds. And oh, by the way, again, we're going to underwrite the results of that and finance it for you. But what ends up happening is Brad and his team's report stays with the borrower as an asset and essentially becomes a roadmap for future retrofit of the building for
Yep.
further energy efficiency as it becomes commercially viable. And so we're as excited about making financing available and understandable to the mass market of commercial real estate, not just those who can figure C-PACE out. But we also are excited about being part of that education of the borrowers that this is not just a today thing, this is a forever thing.
And
I
I,
love that SCP bakes in a decarbonization roadmap in every single loan, and Green Gen does that report. I've seen them. They're very thorough. And to your point, not everything can be done with the initial loan that's provided for the refinance. And so this idea of it being this kind of capital plan roadmap for future retrofits is spot on. I think that that's fantastic. Brad, you were going to
yeah, I
chime
was
in.
going to say, and I think roadmap is the right term to use because inevitably, these projects don't all get done at once. There's some things that are just naturally accretive to the value, and you do them right away. It's a 4-year payback at a 6 cap. It creates a 4-to-1 return on the equity that goes in. There are some things that are essentially focused on improvements that relate to end of useful life, and so these are
Mm,
different, options. There's ROI and incremental capital. Those are done when the equipment fails or as part of a more scheduled budget. And then
hmm
there are things that maybe don't hit the hurdle rate today, but as the cost of energy changes or the cost of water changes, or the cost of technology or regulation, or rebates, that the payback that might have been 8 or 9 years that didn't meet the hurdle rate today, 12 months from now, does in fact meet that hurdle rate, and all of a sudden now it becomes a viable project. And then there are
Yep.
just some things that they're part of the value add opportunity for the next buyer or the next lender.
hmm
Well, and I would add, and this is the exciting part of the relationship of Climate First Bank, Green Gen, and SCP, is we're delivering all of this as a single, three groups delivering a single integrated, easy to understand, easy to execute product. And we will measure our success not only in trying to take a little bit of carbon out of every building and make every building a bit more energy efficient. And to be clear, we're not driving toward net zero. Our view is if we can take out 25%, make a building 25% more efficiency and do that across 1,000 buildings, that's far more impactful than taking 10 buildings to net zero.
Mm.
So we try to do it not only at three groups and one integrated product, but the idea is to deliver in a manner where the borrower's like, oh, that was pretty easy. And then that we become the first call for the next loan and the next
Yes.
loan and the next loan, and that's when we start really having an impact on carbon reduction.
Love it. I wanted to pivot us a little bit into, and Rob, you mentioned it earlier in the call around some of the challenges that building owners and managers face. And one of those that I hear, time and time again is the whole split incentive concept. You have a lot of these, buildings that are triple net leased that, the tenants paying the utility bill, they're going to be seeing the great benefits of all the energy efficiency plays. And so you have this split where the owner is a bit reluctant at time to make these deeper retrofits, knowing that they may not get the same return that the tenant's going to get, right? And I would love to hear from your perspective at CBRE, how you're addressing this, if you've engaged in green lease leaders as an example, and whether that's a pathway forward. And yeah, this topic is really pertinent.
Well, I think the first thing is actually to broker the conversation in a different way between the landlord and the tenant,
Hmm.
right? Because I've been in this circumstance where I'll literally go from one meeting to the next, and the first party, let's say it's the landlord, will say, I do X, Y, or Z, but for the tenant. And then I'll go into the next virtual room, and then the tenant would say, hey, I do X, Y, or Z, but for the landlord because they're not willing to pay for it. And so you have this
Hmm.
opportunity to broker the conversation. And then it becomes very specific to, well, it's a circumstance. Is there a year left on the lease and they want to negotiate a lease like renewal? And so they have a lot of leverage. Or is there 7 years left on the lease, in which case there's an economic incentive in OpEx for the next 7 years for that client. So
Hmm.
maybe they're willing to subsidize, let's say it's a capital project that has a 15-year life, 7/15ths of that project, right? And an expectation that if they renew, it's built into the premium of the next lease. And so part of this is getting rid of this black and white. It's the other person's problem, it's the other person's problem. And actually
Hmm.
saying, no, no, no. Where's the shared value in the moment that you're in that life cycle? And in some ways, is you kind of want to just ignore the lease, right?
Hmm.
Like you want to say, like, don't be bound by this thing, because in a lot of cases, and we see this especially like I'm in New York City, leases that have renewed, and the original lease from literally pre-2000 doesn't deal with some of these circumstances. And
Uh-huh.
so if the lease has that like ability to leverage it, great, our teams will look at that. But a lot of times it's actually an inhibitor and an excuse to do nothing. And we say, okay, put that to the side. And because we sit on both sides in a good way, we have an understanding of what might work for the landlord, or if you're the landlord, what might work for your tenants based on what their profiles are.
Yeah, you're uniquely positioned. And I love the idea of potentially the tenant helping to subsidize a piece of that improvement that they're going to benefit from over a certain period, but not take on the full burden. I think that that's really unique and part of what the green lease leaders want to make a plug for that group, because I think what they're doing to kind of bring those parties together and try to structure this in a way that does make sense for all is moving the needle, and we need to see more at scale. So that's super helpful. We have about 10 minutes left here, and I wanted to throw out one or two additional questions here to you guys, kind of open discussion. One is around this topic of AI. We know that there is this sustainability paradox with AI, and AI drives a significant amount of efficiencies, but at the same time has a huge impact on energy and water consumption and impact in our communities, right? And it's becoming a pretty hot button topic. I'd love to hear you all's perspectives of how you're seeing AI show up in the workplace and you guys' world, and good, bad, or indifferent, kind of how you envision using this new technology as a way to kind of get to the scale we're looking for.
Can I go first because I went last the first time?
Bob, you're up first.
It's a front and center in our life, as it is, I'm sure, almost every business. And there are sort of three elements of AI for us. One is, how do we use it? And for us, it's absolutely a force multiplier. Our ability to process, analyze,
Hmm.
react, and respond has moved forward. It's an amazing tool. The second is, how does it affect our lending and our collateral? And I think that's probably best answered by Rob and Brad. But the third thing is, we our firm is called Sustainable Credit Partners for a reason. It's not called sustainable real estate lending or things like that. We see a huge opportunity in the middle market lending space for what we call powered land, whether it is the land associated with the data centers or the energy generation affiliated with those data centers, or interesting opportunities that we're starting to see in the fragmented EV space, to roll them up and put battery storage behind it. So there's a multi-revenue stream that we can
Mm.
lend against and things. But, it has just opened up our eyes on every front.
Yeah. And so I'm going to jump into it, and I agree. I think there's also a really interesting opportunity, and there's at least two companies that we have spoken with about the following concept, which is right now data centers are big monolithic things, and they sit across, and we've all seen pictures, like multiple football fields worth of, or soccer pitches, I guess, if you want to use the World Cup theme
There we
of,
go.
of space, right? But like the history of energy and power, you have and compute, you start centralized and you go decentralized. The
Mm.
advent of the PC and then now phones, right? So what's happening now is in buildings which have excess ability and capacity for energy, right? Are we going to see a move like we have with energy and solar panels, where compute gets distributed for
Mm.
certain kinds of compute loads? And now all of a sudden, if you have extra space that can be used for compute, you can actually get rent for basement space. And there's
Hmm.
also heat that can be actually tapped into your infrastructure inside the building. So you're actually getting the benefit of rent, somebody paying for that energy, and
And some
excess
thermal
heat.
energy.
It's a really interesting idea, and it's not that difficult to imagine that world starting to evolve. So if I were an owner of a lot of buildings, I'd be starting to think about, wow, where do I have the ability to actually let space that has actually just been space that I get no revenue for?
Yeah.
Kind of like I might have thought about my rooftop in certain markets. So I think that's an emerging thing. The other thing, though, on the flip side is, and I said this earlier, because of not just AI, but also the Gulf War and other stuff, volatility in energy prices is starting to get much more pronounced. So if I were to sit with an investor client, I'd say, hey, even if you're not paying the bills, do you want to be in some sort of place where you can, as a value to your clients, actually start to have a position and provide this as a benefit, which is energy almost as a service for your clients? And
Hmm.
I've seen this too, where it's like, hey, forget where the contract's with, but because the landlord who has a lot of assets can actually think about a portfolio, they can offer stability and often a discount, but at least stability on energy prices as a benefit of being in their building. And I think that is an outgrowth of what's happening in AI. So I actually think there's a lot of interesting opportunities that I'll call it leading edge creative investors are going to take advantage of sooner rather than later.
Excellent points, Rob. Brad, you came off
Yeah,
mute
no,
too.
I was going to say, I think people talk a lot about renewables, about whether they're going to drive revenue, and I think that's important, but I think that misses the point. What renewables do more than anything else is they reduce the volatility of the spend. And so if you put solar
Mm.
in there and, let's say it's all of your building, for the next 20 years, what your cost of power is going to be. And people spend enormous amounts of time on trying to lease buildings and get higher rents. They don't want to see it erased by one of their big commodities, one of their big expense lines go up. That's the problem with insurance with rises right now. That's the problem with, the cost of power rising so much.
Hmm.
And so I think, what we're all talking about is how to create value, across real estate. I love the fact that, Rob made this point because I sit on the board of FlexNode, which is one of these companies that is essentially smaller, modular, liquid cooled, that is, in fact, has the ability to go into vacant space. And real estate is all about creating, rent and revenue per square foot. And so you don't care whether it's a doctor's office or it's a bank or it's a data center company that's using space. You just want to know that you're driving the revenue per square foot.
Mm.
And I think, that type of situations, those types of, DC smaller, more modular, more nimble, have a really important place because there's already power to the building. That's the other part is like, these big giant hyperscaler, data centers are applying for power and they're in a queue for maybe, years. Oftentimes, office buildings have available power and you can put in a modular data center like tomorrow and have power that goes to it and it can be reducing the latency because it's closer to the end users, whether they're in your building or across the street. And
Mhm.
increasingly, latency is an issue for a lot of, data center users.
Yep. Now that was a very interesting point, Rob, about the edge AI. I've heard a lot about, how things may be actually moving to the distributed world and yeah, could be a new revenue opportunity for some of these buildings, right, that are sized up for it. Bob, any last thought on this topic and we'll close this out.
No, I'm gonna just take the coward's way out and just agree with Rob in that, we're seeing across the board for all the conduit capital businesses this migration from the big centers to the more distributed centers. And that you started by making the point, and this webinar is entitled "The Unlocking the Missing Middle." We
Hmm.
think that missing middle tag goes across a lot of that transition right now and creates a lot of opportunities for us as a lender, be it on the CRE side or revenue finance side or vendor finance side, in that transition from these big projects to these more distributed projects.
Fantastic. Thank you all for the remarks today. This has been really enlightening, and I hope all of the audience has also gotten some good insights from it. I think in closing, one key takeaway for me is that this middle market gap that we've been talking about isn't the lack of opportunity. It's usually and is this lack of alignment between the need, the execution, the capital, all of these, parts coming together. And the more that we close that gap, the more that we unlock real progress, not only for the building owners, but for the climate as well. And so I just want to thank you all as our panelists and to everybody who joined us today and encourage you all to connect offline, check out CBRE's work in sustainability, look up Green Gen and the excellent work that they're doing to help buildings demystify what they could do. And of course, SCP and the Sustainable Credit Partners and the very innovative financing approach to make this a one-stop shop for these middle market owners to make it easy for them. I'm hoping that today's discussion really does give you a clear view of where to start, what to ask for, and what kinds of support you'll be available as you continue this retrofit strategy. So, with that, thank you all so much for the time and look forward to the next discussion.
Thank you, Chris. Take care.
Chris, thank you.
You
Thanks,
too.
Rob. Thanks,
Bye bye.
Bob. Bye.
Bye-bye.